Did you notice the upward swing in the markets, particularly with the Nifty 50 hitting unprecedented levels of 22,000? Well, this surge isn't happening in isolation. It's about various fundamental factors which are contributing towards growth. Now, if you want to know why, there are plenty of reasons mentioned in a report titled The State of the Economy released by the RBI yesterday. Now, let's dissect this report and understand the fundamental strength better. Now, the main theme of the report revolves around the robustness of the Indian economy. High-frequency indicators suggest that the momentum achieved in the first half of FY24 is expected to be sustained. For instance, indicators like e-way bills and toll collections have shown significant growth rates indicating a buoyant economic activity. Automobile sales, including two-wheelers and tractors, have also seen substantial growth. When we talk about the GDP growth, the RBI's official forecast indicates a moderation in the GDP growth to 6.5% in the last quarter of calendar year 2023 from the blockbuster figure of 7.6% in the July to September period. Now, to meet the annual estimate of 7.3%, real GDP would need to expand by 7% in the last quarter of the financial year. One notable trend is the moderation in inflation, which is averaged at 5.1% in the month of January. Although food price inflation continues to introduce volatility, the core inflation excluding food and fuel has moderated to a 4-year low of 3.8% in the month of December. Now, this decline in core inflation is a significant positive indicating stability within the economy. However, the RBI remains vigilant against high food inflation and acknowledges the uncertainty in this area. And the importance of maintaining stable and low inflation at around 4% is emphasized in the report yet again. The report underscores the resilience of both the manufacturing as well as the services sectors. Industrial activity is on the rise, buoyed by improved manufacturing performance. Early corporate results indicate optimism driven by higher profit margins. Now, the Purchasing Managers Index, or the PMI for manufacturing, reflects expansion accompanied by strengthening future activity index. Similarly, the services sector is anticipated to remain robust due to strong domestic demand and favorable global prospects. Notably, the PMI for services saw a significant rise in the month of January, indicating sustained expansion. Now, the report sheds light on the capital expenditure cycle, suggesting mounting expectations that private sector investments will lead the next phase of growth. Now, this optimism stems from healthy balance sheets among companies and favorable inflation developments, creating a stable environment conducive for capacity expansion ahead of an anticipated demand upswing. Now, the February report maintains an optimistic outlook regarding the global economy. While global trade momentum has been weak, signs of recovery are evident with anticipated faster growth in 2024. The likelihood of stronger than expected global growth in 2024 has increased, with risks being broadly balanced. Now, this resilience in global growth is expected to benefit Indian companies reliant on external demand, such as IT service firms, facilitating their bounce back. Now, despite the positive outlook, the report also highlighted persisting geopolitical risks. The ongoing hostilities in the Red Sea have led to a surge in container shipping costs. Reduced volumes passing through the critical Suez Canal in January 2024 have resulted in increased transit times, subsequently driving up shipping costs and insurance premium. Now, it's important to note that while the report was authored by the RBI officials, it carries a disclaimer stating that the views expressed are those of the authors and not necessarily reflective of the central bank's stance. Nonetheless, these insights provide valuable context for understanding the current state of the Indian economy and for the factors driving its trajectory forward. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment related documents carefully. Visit www.researchandranking.com